Let's dive in, shall we? Today, we're taking a deep dive into, well, a deep dive, the 2008 financial crisis. And we've got some pretty interesting stuff to work with here. Some excerpts from a presentation by this financial expert, Doug Fabian.
Oh, yeah, Fabian.
Yeah, and it's fascinating stuff. We're going to unpack what happened, why it matters, and most importantly, what can we learn from it? How can we apply those lessons today?
Yeah. And, a lot of people, when they hear 2008, they just think crash. Right?
Oh, yeah.
But Fabian, he really starts by setting the scene. He talks about this credit bubble.
Okay, so a credit bubble. What does that even mean? Like, for someone who's, not a financial whiz.
So imagine like a balloon, right?
Yeah.
And you just keep blowing it up way beyond its limits.
Uh-huh.
That's what was happening in the years leading up to 2008. Easy credit was flowing everywhere. Mortgages, construction loans, credit cards, business loans. Everyone was borrowing, spending, and it pushed prices up artificially.
So it wasn't just about houses like a lot of people think.
No, it was much bigger than that. It was systemic.
Right.
But housing was definitely a big part of it. Fabian, he talks about this housing bear market, which means prices were dropping like significantly.
Yeah.
A 15 to 20% decline domestically and even internationally.
Oh.
And that's when those dominoes really started to fall.
And in the presentation, he doesn't really sugarcoat the potential consequences either.
No.
He talks about like a further 20 to 30% drop in housing, a full-blown recession, the stock market crash. I mean,
Yeah.
it's pretty scary stuff. It makes you wonder, like, how did anyone see this coming?
Well, that's where those charts come in. He's got these charts of the S&P 500, which for our listeners, it's the index that tracks, 500 of the largest U.S. companies.
Right.
And if you look at the 10-year chart, you see this gradual upward trend. But then you zoom in on the 1-year chart leading up to 2008.
Mm-hmm.
And it's like a roller coaster heading straight down.
So the writing was on the wall if you knew where to look.
Yeah, you could see it coming. But here's where it gets really interesting. Fabian, he doesn't just leave us with, doom and gloom.
Right.
He lays out these 3 key trading strategies for a difficult market. Index funds, sector funds, and commodities.
Okay, so let's break those down. Let's start with index funds. Now, I know some of our listeners might not be, super familiar with index funds. So can you give us a quick, explain it like I'm 5,
Okay.
ELI 5?
So imagine instead of picking individual stocks, you buy a basket of them.
Right.
All tied to a major market index like the S&P 500.
Mm-hmm.
That's an index fund.
All right.
So you're essentially betting on the overall performance of the market or a specific sector.
And Fabian specifically talks about ETFs, exchange-traded funds.
Yeah.
Which are kind of like index funds, but they're traded on the stock market.
Yeah.
And then he dives into these ultra ETFs. So what makes them different? What's the ultra all about?
Okay, so ultra ETFs, what they do is they aim to amplify the daily movements of the index they track. So let's say the S&P 500 goes up 1%.
Mm-hmm.
An ultra ETF tracking it might aim to go up 2%.
Oh, okay.
But, and this is important,
Yeah.
that amplification works both ways.
Oh, okay.
So if the market goes down, your losses are magnified too.
So it's higher risk, higher reward.
Exactly. You got to be careful with those.
Yeah. Well, and his presentation, it includes these tables showing that, while the S&P 500 was down 25% in 2008,
Right.
its ultra-short ETF, which profits when the market goes down,
Right.
it was actually up over 20%.
Yeah, that's a
Is that
thing.
what's-
There are ways to potentially, profit even when the market is going down.
It's like turning lemons into lemonade, financially speaking.
Exactly.
Okay, so index funds, that's like a broad approach to the market.
Mm-hmm.
But what if you want to get more targeted? What if you want to zero in on a specific part of the economy?
That's where sector funds come in. So these ETFs, they focus on specific sectors of the economy, like energy, financials, healthcare. And just like with index funds, you have the ultra options, both long and short.
So you can bet for or against a particular sector.
Exactly. You can play both sides.
Interesting. And so, for example, his presentation, it highlights the financial sector,
Yeah.
which was, that was hit hard in 2008.
Oh, yeah.
Their ultra long ETF was down a painful 43%.
Ouch.
Yeah, ouch is right. But their ultra-short ETF, the one betting against the sector,
Right.
it was actually up 12%.
Yeah, it's about understanding the dynamics at play and having a strategy,
Right, so it's not just about, hoping for the best.
No.
It's about understanding how these different tools work and using them strategically.
Exactly. And Fabian, he even includes a chart.
Does he?
Yeah, specifically tracking that ultra-short financials ETF just to really drive the point home. And you see this huge spike right when the financial sector starts tanking.
Wow. It really shows you, the power of understanding how these different tools work.
Yeah, and the importance of having a plan. Fabian, he's not saying that everyone should have shorted the market in 2008.
Right.
But he's showing that by understanding the dynamics at play, you can potentially find opportunities even in a crisis.
Right. So it's about being prepared. It's about understanding the tools and knowing how to use them. Now, there's one more strategy he talks about. Commodities.
Right.
So things like gold, oil. What's the deal with those?
Commodities. They're often seen as a hedge against market turmoil.
Okay.
So think of it this way. When the stock market is crashing, economy's uncertain, people get nervous, right? They want something stable to hold on to.
So they flock to gold like a safe haven.
Exactly. And Fabian, he points to the Street Tracks Gold ETF, which tracks the price of gold.
Okay.
And he includes a chart showing how it performed in 2008. And it's pretty steady, compared to the wild swings of the stock market.
Yeah.
He also mentions ETFs that track oil.
Okay.
Both long and short.
Right.
Because even commodities, they can be volatile.
Oh, for sure.
So you gotta be careful with those as well.
It's like having different tools for different parts of the journey.
Right.
So you've got index funds, sector funds, and commodities, all offering ways to potentially navigate a difficult market. But Fabian, he doesn't stop there. His presentation also includes charts for other sectors and markets.
Oh, yeah.
Like healthcare, real estate, emerging markets.
Right.
What's he getting at with those?
Well, he's showing how different parts of the market, they react differently during a crisis.
Okay.
For example, the healthcare sector. It's often seen as more stable, right?
Right, because people always need healthcare.
Exactly. People always need healthcare.
That makes sense.
So even in 2008, it held up relatively well.
Okay.
But real estate, on the other hand, given the housing bubble we talked about,
Yeah, that's a different story.
that's a completely different story.
Right.
That chart, it just shows how interconnected everything is and how one sector's crisis can just ripple through the entire market.
Yeah.
It's like a chain reaction.
Wow. So, we've covered a lot of ground already. Index funds, sector funds, commodities, all these charts and strategies. What do you think is the most important takeaway for our listeners so far? What's the so what of all this?
Well, it's interesting when you look at all of this.
Yeah.
It challenges the way we usually think about market downturns, right? We're so conditioned to think crisis equals loss.
Right.
But Fabian, he's showing us that that's not always the case. There are ways to not just survive, but potentially even profit during a downturn.
Right. It's about having the right tools and the right knowledge to navigate those choppy waters.
Exactly. And that's what these strategies, index funds, sector funds, commodities, that's what they're all about. They're not magic bullets,
Right.
but they're tools that, when used correctly, they can help you navigate the ups and downs. And it's all about diversification too, right? Oh, yeah.
Not putting all your eggs in one basket.
Absolutely. Investing 101.
Yeah,
But it becomes even more crucial when the market is volatile.
for sure.
I was talking to a friend the other day who's just starting to invest, and they were really nervous
Oh, yeah.
about, another 2008 happening.
Understandably so.
Yeah. What would she to someone who's feeling that fear?
I would say, first of all, it's completely understandable to feel that way. Nobody wants to see their investments disappear.
Right.
But fear, it can be paralyzing and it can lead to bad decisions. The key is to educate yourself, understand how markets work, and have a plan. You can't control the market, but you can control your reaction to it.
So it's not about trying to predict the future, but about being prepared for whatever comes your way.
Exactly.
Yeah.
And that's where learning from the past can be so valuable. We can't perfectly predict what will happen.
But history often rhymes. By studying events like 2008, we can gain insights into how markets behave under stress and what strategies might help us navigate similar situations.
That's actually a really good segue to a question I had.
Okay.
We've been focusing on the strategies themselves. But Fabian's presentation, it seems to emphasize a certain mindset as well, wouldn't you say? It's not just about the technical stuff.
Oh, absolutely. It's about cultivating a mindset of resilience and adaptability because let's face it, in the markets, the only constant is change.
Right. And he challenges this idea that a downturn is purely negative.
Yes,
He presents it as a potential opportunity.
that's right. He talks about how some investors, they didn't just weather the storm of 2008. They actually came out ahead. And that's because they were prepared, they had a strategy, and they were able to see the opportunity in the chaos.
Right. It's like finding that silver lining or, like we said before, turning lemons into lemonade.
Exactly. And that's a powerful concept for any investor, regardless of experience level. It's about shifting your perspective from fear to opportunity.
So let's go back to those charts that Fabian included for, healthcare, real estate, and emerging markets. What story do they tell about how different parts of the market react during a crisis? Like, what are the nuances there?
Well, they show that some sectors are more resilient than others, like healthcare. Like we talked about, it's considered a defensive sector because people always need medical care, regardless of the economy. So even in 2008, it held up relatively well. But real estate, well, given the housing bubble,
Yeah.
that chart paints a very different picture. It's a stark reminder of how interconnected everything is in the market and how one sector's crisis can spread to others. And then emerging markets, that chart shows how a crisis in one part of the world can quickly spread to others. Emerging markets were experiencing rapid growth in the years leading up to 2008, but they were also impacted by the global financial meltdown. It's a reminder that even if you're not directly invested in the U.S. market, a global crisis can still affect your portfolio.
Right. So it's about understanding that, what happens in one part of the world can definitely have ripple effects.
Absolutely. It's all connected.
And that's why diversification is so important. Spreading your investments across different asset classes, sectors, geographies, it can help mitigate your risks.
Exactly. Don't put all your eggs in one basket.
Now, earlier you mentioned that fear can lead to bad decisions.
Yeah.
Can you give an example of what that might look like in a situation like 2008? Like what kind of bad decisions are we talking about?
Well, a classic example is panic selling. When the market starts to drop, people get scared. And they sell everything, often at a loss because they're afraid of losing even more.
Right. But isn't that sometimes the right move, like to cut your losses before things get worse?
It can be tempting, but often it's driven by emotion rather than logic.
Okay.
Remember those ultra-short ETFs we talked about? Some investors, they saw the downturn coming and actually profited by betting against the market. They didn't panic. They had a plan.
Right. So it's about taking a deep breath, assessing the situation,
Yeah.
and making informed decisions rather than reacting out of fear.
Exactly. And having a long-term perspective can help with that. Market downturns are inevitable,
Right.
but they're usually temporary. If you have a solid investment strategy and you stick to it, you're more likely to come out ahead in the long run. I remember reading about investors who sold everything at the bottom of the market in 2008,
Oh, no.
only to miss out on the huge rebound that followed.
That's got to be heartbreaking.
It's a common story, unfortunately, and it highlights the importance of patience and discipline in investing. It's almost like a test of your emotional intelligence as much as your financial knowledge.
Right. You got to have both. So going back to what you said earlier about learning from the past, if our listener could go back and give their 2008 self one piece of advice, what do you think it should be? Like, what's the one golden nugget they should take away?
That's a great question. And it's so personalized, isn't it?
Right.
It depends on their individual circumstances, their risk tolerance. But I think a good piece of universal advice would be focus on the long game. Don't let short-term market fluctuations derail your long-term investment goals.
Right. It's easy to get caught up in the day-to-day, the ups and downs.
Yeah.
But zooming out, remembering your big picture goals can really help you stay focused.
Exactly. It's about keeping your eye on the prize. And I think another important piece of advice would be to diversify your portfolio. Don't put all your eggs in one basket. We've said it before, but it's worth repeating.
Right. So we've got long-term thinking and diversification. Anything else?
I think one more crucial piece of advice would be to stay informed. Keep learning about the market, understand the different investment options available to you, and don't be afraid to ask questions. That's where resources like this deep dive come in.
Right, exactly.
The more knowledge you have, the better equipped you'll be to make sound investment decisions, no matter what challenges the market throws your way. It's about empowering yourself, isn't it? And that's what I hope our listener takes away from this deep dive. It's not about predicting the future. It's about being prepared and informed so you can make the best decisions for your own financial well-being.
Absolutely. All right, so we've traveled back to 2008. We've learned from those who navigated that turbulent time. How can our listener apply those lessons to their own investment journey today? Like, what are the next steps?
Well, I think the first step is to take stock of your current situation.
Okay.
What are your financial goals? What's your risk tolerance? Once you have a clear understanding of where you stand, you can start to develop a plan that aligns with your individual needs and circumstances. It's not about blindly following what worked for someone else in 2008. It's about adapting those lessons to your own unique situation.
Right. So it's not a one-size-fits-all approach. It's about tailoring your strategy to your own individual needs.
Exactly. And it's about being proactive. Don't wait for a crisis to happen before you start thinking about your investments. Start planning now, and you'll be much better prepared to weather any storm that comes your way.
Now, we've talked about the importance of diversification, but what does that actually look like in practice? Can you give our listeners some concrete examples?
Sure. Diversification means spreading your investments across different asset classes, sectors, and geographies.
Right.
So instead of putting all your money in stocks, you might also consider bonds, real estate, commodities. And within each asset class, you can further diversify by investing in different sectors and regions.
So it's about not putting all your eggs in one basket, literally and figuratively.
Exactly. And the level of diversification that's right for you will depend on your individual circumstances. But as a general rule, the more diversified your portfolio, the lower your risk.
So it's about finding that balance between risk and reward.
Exactly. And that's where understanding your own risk tolerance is so important. If you're comfortable with a higher level of risk, you might allocate a larger portion of your portfolio to stocks, which have the potential for higher returns, but also come with more volatility.
Right.
If you're more risk-averse, you might favor a more conservative approach with a greater emphasis on bonds or other less volatile assets. It's like choosing the right path for your own personal financial journey.
I like that. It's about finding your own path.
Exactly. And it's important to remember that your journey is unique. There's no right or wrong answer when it comes to investing.
Right.
What matters is finding a strategy that aligns with your own goals and values.
Now, you mentioned the importance of staying informed. Right. Where can our listener go to find reliable information about investing and the market? Like, what are some good resources?
Oh, there are so many great resources available today. Reputable financial websites like Investopedia, The Motley Fool. They offer a wealth of information for investors at all levels.
Right.
And of course, financial advisors can provide personalized guidance and support.
So it's about finding sources you trust and that speak to your level of understanding.
Exactly.
Yeah.
And it's important to be critical of the information you encounter. Don't just believe everything you read or hear. Do your own research, ask questions, make informed decisions.
Now, we've covered a lot of ground today, from the specifics of the 2008 financial crisis to, broader investment strategies. As we wrap up this part of our deep dive, is there anything else you'd like to emphasize for our listener? Like, what's the key takeaway here?
I think the most important thing to remember is that investing is a journey, not a destination. It's about continuous learning, adapting, and growing. And it's about finding joy in the process. Don't let the fear of making mistakes hold you back. Embrace the challenges, celebrate the successes, and remember that every experience is an opportunity to learn and improve.
I love that. It's about embracing the journey and enjoying the ride. Speaking of which, we're coming up on a pivotal point in our own journey through this deep dive.
Okay.
We've explored the past, we've dissected strategies, we've tackled tough questions. Now it's time to shift gears and connect those dots to the present. 2008 was a while ago, and the market has changed a lot since then. So how do we take those lessons from the past and apply them to the market today? That's what we're going to be exploring in the next part of our deep dive.
Yeah, that's the good question.
So stay tuned. We'll be right back. So we spent a lot of time, digging into 2008, the causes, the consequences, the strategies. But you're not prepping for a time machine. You're navigating the market today.
Right.
So how do we bridge that gap?
Yeah, that's the million-dollar question, isn't it? And it's where I think critical thinking comes in.
Okay.
History often rhymes, but it doesn't repeat exactly. We can't just copy-paste 2008 strategies into 2024 and expect the same results.
It's not about predicting another crash, but about understanding the underlying principles at play.
Exactly. What made those 2008 strategies work wasn't just what they were, but why they were effective in that specific context.
Okay.
Take index funds, for example.
Right. We talked about how some investors used ultra-short ETFs to profit from the market downturn. But wouldn't that be risky if you, misjudged the timing?
Absolutely. That's why it's crucial to understand the why behind any strategy. In 2008, there were clear signs of a bubble and a looming downturn.
Right.
But today's market is different.
So it's not just about the tools themselves, but about knowing when and how to use them.
Exactly. And that requires staying informed about current economic conditions, understanding market trends, and honestly, a bit of humility.
Right.
Nobody has a crystal ball.
This is making me think about that conversation I mentioned with my friend who's new to investing.
Yeah.
They were asking if now is even a good time to get started, with all the talk of potential recessions and such.
Yeah, that's a common concern. But remember, investing is a long game. And market downturns, while scary, can actually create opportunities for those who are prepared.
It's like those ultra-short ETFs. They only shine when the market is down right.
Precisely.
Yeah.
And while I'm not recommending anyone rush out and short the market, the point is that different market conditions call for different strategies.
Okay, so if our listener is thinking, all right, I get the 2008 lessons, but how do I actually apply this today? What's step one?
Self-awareness.
Okay.
Before you even look at charts or ETFs, understand your own financial goals, your risk tolerance, and your time horizon. Are you saving for retirement, a down payment, and something else? How much risk are you comfortable with?
It's like figuring out your destination before choosing the vehicle.
Perfect analogy. A sports car might be great for speed, but not so much for hauling cargo. Similarly, a high-growth stock might be right for a long-term investor, but too risky for someone needing cash soon.
And this is where diversification comes in, right? Like we discussed, spreading your investments to balance risk and reward.
Exactly. But diversification isn't just a checklist.
Right.
Okay, I own some stocks, some bonds, I'm good. It's about understanding the why behind each choice.
So using those 2008 examples, it's not enough to just buy some gold because it did well back then.
Right. Gold can be a hedge against inflation or uncertainty, but it's not a guaranteed win. You need to understand its role in your overall portfolio and how it might perform under different conditions.
It's like building a puzzle, isn't it? Each investment piece needs to fit into the bigger picture.
That's a great way to visualize it. And just like a puzzle, it takes time and patience to get it right. There's no rush.
And I imagine this is where having a financial advisor could be helpful, like a guide to help you navigate the options.
Absolutely. Especially if you're new to investing or feeling overwhelmed. An advisor can help you create a personalized plan, explain the nuances of different strategies, and even help you manage those emotional ups and downs that inevitably come with market fluctuations.
So circling back to where we started connecting 2008 to today, what's the big takeaway you want our listener to walk away with?
Knowledge is power, but only if you use it. Studying the past helps us understand market dynamics, identify potential risks and opportunities, and make more informed decisions. But it's not a magic formula.
So no crystal balls, but a sharper lens through which to view the market.
Exactly. By combining historical insights with present-day awareness and a solid understanding of your own financial needs, you can navigate even the most challenging market conditions.
This has been incredibly insightful. Thank you for guiding us through this deep dive into the 2008 financial crisis and beyond.
My pleasure. Remember, the most successful investors aren't those who can predict the future,
right,
but those who are prepared for whatever it may bring.
And on that note, we'll leave you, our listener, with a final thought to ponder. Imagine you're writing a letter to your future self 5 years from now. What investment advice would you give based on what you've learned from this deep dive? What steps will you take today to set yourself up for success in the years to come? Until next time, happy investing. All right, so we're back. And, we've spent a lot of time, really digging into 2008. The causes, the consequences, the strategies.
Right, there's a lot to unpack there.
Yeah, but, our listeners, they're not prepping for a time machine, right?
No, definitely not.
They're navigating the market today.
Right, that's the key.
So how do we bridge that gap? How do we take those 2008 lessons and make them relevant for right now?
Yeah, that's the million-dollar question. And that's where I think critical thinking comes in, right? Because history, it often rhymes, but it doesn't repeat exactly. So we can't just copy-paste those 2008 strategies into 2024 and expect the same results.
So it's not about predicting another crash, but it's about understanding the underlying principles.
Exactly. What made those 2008 strategies work wasn't just what they were. but why they were effective in that specific context. Like, take index funds, for example.
Right. Right. We talked about how some investors use those ultra-short ETFs to profit from the market downturn.
Yeah.
But wouldn't that be risky if you, misjudge the timing?
Absolutely. And that's why it's so crucial to understand the why behind any strategy. In 2008, there were clear signs of a bubble, a looming downturn. But today's market...
It's different.
It's different.
Yeah, so it's not just about the tools themselves, but about knowing when and how to use them.
Exactly. And that requires staying informed, about current economic conditions, understanding market trends, and honestly, a bit of humility. Nobody has a crystal ball.
Right. This is making me think about that conversation I mentioned, with my friend who's new to investing. They were asking, is now even a good time to get started with all the talk of potential recessions and all that?
Yeah, that's a common concern. But remember, investing is a long game, and market downturns, while scary, they can actually create opportunities.
For those who are prepared.
For those who are prepared.
Right. It's like those ultra-short ETFs. They only shine when the market's down.
Precisely. And while I'm not, recommending anyone rush out and short the market, the point is different market conditions call for different strategies.
Okay. So if our listeners thinking, all right, I get the 2008 lessons, but how do I actually apply this today? What's step one?
Self-awareness. Before you even look at charts or ETFs. Understand your own financial goals, your risk tolerance, your time horizon. Are you saving for retirement, a down payment on a house, something else? How much risk are you comfortable with?
Right. It's like figuring out your destination before you choose the vehicle.
Perfect analogy. A sports car might be great for speed, but not so much for hauling cargo. Similarly, a high-growth stock might be right for a long-term investor, but too risky for someone who needs cash, in the short term.
Right. And this is where diversification comes in, right? Like we've discussed, spreading your investments to balance risk and reward.
Exactly. But diversification isn't just a checklist.
Okay.
I own some stocks, I own some bonds, I'm good. It's about understanding the why behind each choice.
So using those 2008 examples, it's not enough to just buy some gold because it did well back then.
Right. Gold can be a hedge against inflation or uncertainty, but it's not a guaranteed win. You need to understand its role in your overall portfolio and how it might perform under different conditions.
It's like at building a puzzle, isn't it? Each investment piece needs to fit into the bigger picture.
That's a great way to visualize it. And just like a puzzle, it takes time. It takes patience to get it right. There's no rush.
And I imagine this is where, having a financial advisor could be helpful.
Absolutely.
Like a guide to kind of help you navigate all the options.
Especially if you're new to investing or feeling overwhelmed, an advisor can help you create that personalized plan, explain the nuances of different strategies, and even, help you manage those emotional ups and downs that inevitably come with market fluctuations.
Yeah. So circling back to where we started, connecting 2008 to today, what's the big takeaway you want our listener to walk away with?
I think the most important takeaway is that knowledge is power, but only if you use it. Studying the past, it helps us understand market dynamics, identify potential risks and opportunities, and make more informed decisions. But it's not a magic formula.
So no crystal balls.
Our crystal balls.
But a sharper lens through which to view the market.
Exactly. By combining those historical insights with present-day awareness and a solid understanding of your own financial needs, you can navigate even those challenging market conditions.
This has been incredibly insightful. Thank you so much for guiding us through this deep dive into the 2008 financial crisis and beyond.
It's been my pleasure. And remember, the most successful investors, they're not those who can predict the future, but those who are prepared for whatever it may bring.
And on that note, we'll leave you, our listener, with a final thought to ponder. Imagine you're writing a letter to your future self 5 years from now. What investment advice would you give based on what you've learned from this deep dive? What steps will you take today to set yourself up for success in the years to come? Until next time, happy investing.